Welcome back, and we're here to talk about how do we convert a primary residence or an investment property for personal use. Now, why would we do this and how can it work? I'm going to go first with let's convert a primary residence that we've never held for investment. And we're going to need to say that, look, we get a $500,000 exclusion for a married couple or $250,000 for each taxpayer on title for the property that gets this exclusion called Section 121. Now, why is Doug talking about 121 when he's a 1031 exchange specialist? Because a lot of our clients don't understand these can intertwine with each other if handled correctly. Now, let's say, for example, you're selling your primary residence. You've lived there 2 of the past 5 years to qualify, and you haven't sold another primary residence in the most recent 2 years. You qualify for this exclusion of up to $500,000 for a married couple or $250,000 for a single person. Well, what if you have more than that gain? That's not unheard of in today's market. I mean, look what's happened. There are properties that you've held for 20 years that you bought for next to nothing, and it was everything you had 20 years ago, but now you're selling it for $1 million. How do you deal with this extra gain that you're going to pay a lot of taxes on? Well, how that works is if you just simply stop using it for your personal residence and make it an investment and hold it for at least 2 years like that for 24 months, it will qualify for a 1031 exchange, meaning 100% of the value can be exchanged through 1031 and deferring 100% of those taxes if done properly. But you say, what about my $500,000 or $250,000 that I'm supposed to get tax-free? Well, if you can make that transaction, the sale of that property happen before the 36th month after you move out, you can still qualify for both a 1031 exchange and a 121 primary residence exclusion. It's magical. So what would happen is, I explain to clients all the time, move out and rent the property to others for their use as investment. You'll get the tax deductions, depreciation, all those fine tools to help you with this property. The difference is you'll need to sell it to someone else that's not related to you by the 36th month. So I typically tell my clients, don't rent it out, don't renew the lease after the second year, because you'll need time to fix the property up for sale, get it on the market, and sell it and transfer title before the 36th month. Again, very simple to do. You get to say, okay, I bought the property for $100,000 20 years ago, and I'm selling it, for example, for $1 million. You'll get your basis moved with the 1031 exchange, but you can take $500,000 of this money tax-free as your primary residence exclusion for a married couple. That's significant because now you can 1031 exchange the balance and buy an investment property with that to continue with the income stream that you've already started to enjoy by renting the property out. It is a perfectly, it needs to be thought about before selling a highly appreciated piece of a primary residence. Now, the question always comes up, who can be the tenant? So again, anybody can be the tenant as long as you charge the same rent you would charge somebody that's not a related party to you. The IRS does not want you to rent it out to your family member for $100 a month. That's not being an investor. An investor would charge market rents, whatever that might be in that segment for that property. And you will not gift that money to your tenant to give back to you as part of this deal. I would not advise that. But I'd always advise you to check with your CPA and let them know what you're doing so that they can report this correctly on your tax returns, and your family member, if it happens to be a family member that's renting the property from you. Charge them market rents. They will sign a lease. You will evict them if they don't pay the rent on time. You will charge them penalties. You'll make them do whatever the terms a normal investor would do when renting out an investment property. The only difference is you will sell that property to somebody else as part of a 1031 exchange later to get your both benefits. Again, that's converting a primary to investment so you can get the benefits of both of these transactions. Now, what if I have an investment property I bought with a 1031 exchange that I would like to move into? That is perfectly fine. You can convert a property purchased with a 1031 exchange to be personal use. The difference is you must first satisfy the 1031 exchange when you sold your investment property to buy this asset. It can never be your intent to buy a home that you want to live in as part of a 1031 exchange. But that doesn't mean you can't convert the asset later in life. Things change. You want to retire in a community. A lot of my investors, including myself, I'm only going to buy properties at this point in my life. Not only, but most of the smaller properties I buy are going to be in communities and places that I wouldn't mind living when I finally retire. And again, it's not, I don't know if I'm going to move into it or not. I'll be renting it out for at least 24 months before I decide to convert it anyway. And I don't know what my future is going to hold or where I might be. But by converting it, it's real simple. It's not something special you have to do on title. You just have to let your accountant know that you moved, obviously, from your current primary, and you're going to make that your home. Or maybe it's going to be your vacation home, and you're not going to use it primarily for investment. You want to use it more personally. You can do that as part of this 1031 exchange after 24 months. The first 24 months, though, you're limited to your personal use of that asset to basically 14 calendar days per year, or 10% of the time it was actually used for investment during that calendar year. But you should never convert the asset without a valid reason before 24 months. And when you move into it, it's real simple. Let your accountant know, make it now your primary or your second home or whatever it is you're using it for, and continue on. I want to give one caveat, though. The conversion process here is a little bit different, because when you can buy a property as part of the 1031 exchange, what ends up happening is a lot of clients feel that you're able to sell that asset as part of your 121 primary residence by living there 2 years. Unfortunately, the laws changed for that in 2009. Believe me, it was the number one tool to be able to walk away with a lot of tax-free money, but the IRS did realize that was probably a bad idea, and they changed the rules in 2009. How it works now is this. If you own a primary residence, you've lived there 2 of the past 5 years, you haven't sold another primary in the most recent 2 years, you can't sell this one for a $250,000 or $500,000 exclusion anymore. You get a pro rata share of the time it was an investment since 2009 or used as a primary since 2009. So let's say now this year is 2025. That's 16 years basically since 2009 that you've held it for investment. You do a 1031 exchange, sell an asset, and you buy another, you don't do a 1031, you simply move into the property. By moving into the property, you live there for 2 years. You can sell it as your primary residence because it no longer qualifies for a 1031. It's being used personally. You will get 2 years of the last 7 to 18 years now tax-free as part of your primary residence. So the percentage, a very small percentage, and you'll pay tax on the rest because it does not qualify for a 1031. So again, it's not a great idea for that, but it's an amazing idea if you're planning on retiring and want to have a retirement home. So I'll do a 1031 exchange today and buy something, for example, in Florida if I want to retire there. Maybe it's 3 years, 5 years down the road. I don't know if I'm going to or not, but everywhere I buy certain assets, these are places I might want to retire later, because I know if I wait, I may not be able to afford to retire there later. So I'll buy it today with a 1031 exchange, and when I convert it later in time, that will simply be that I move into the property and stop using it for investment. If I want to requalify that asset for a 1031 exchange, it's real simple. Stop using it personally for 2 years and rent it out to somebody else. Some practitioners, your CPAs or tax advisors, might say that 1 year and 1 day is sufficient. And that's totally true. We're not the police. But I wouldn't recommend doing anything short term. I would at least have 2 tax cycles of the asset being held as investment on 2 tax returns at bare minimum. Other than that, we want to make sure you check with your team on that. But that's how we convert assets to and from investment or to and from primary residence use. It's been exciting, and a lot of clients taking advantage of that, because I tell them all the time that when you do that, you have a home to move to. And you can sell the current primary you're in and have that money tax-free up to $500,000. And have that money to be able to clean up all of your finances when retirement comes, take care of your debts, and basically step into a very significantly positive retirement with little or no liabilities dragging on your anchor. So it's been a pleasure sharing this topic with you. Again, thank you for sharing or listening.